in this video, we're going to go through a step-by-step guide to how to start investing. This video is going to be split into four main parts. The first is going to be why you should be investing. The second is going to be the mechanism or the vehicle that you can use to start investing. The third, we're going to cover some of the key products and providers that you can use to start investing. And fourth, we're going to be talking about mistakes that you really want to avoid when it comes to investing. So let's moneyball this. Some of this stuff is complicated. In my view, it's unnecessarily complicated, and that's really what we're going to try and distill in this video. So the first question obviously is, why should you be investing? And the short answer is, you can only trade your time for so many hours in a day at a particular fixed rate. And this is kind of limiting when it comes to building your wealth. So the key thing, the fundamental thing that investing does, is it puts your money to work for you so it can be working when you can't, or even better, whilst you're working as well. And one of the key things that will ultimately erode the value of your money over time is inflation. So if you put £10,000 into a bank account and you leave it there, let's just say you earn no interest, gradually over time, month by month, year by year, the value that £10,000 has will erode over time. It will be able to buy you less stuff than it can now. And so one of the key things that investing will really do is it will help to beat that rate of inflation. This is something that we talked in a previous video, a bullshit boom of financial advice you should definitely ignore, and I think this is it. You cannot just be saving for retirement, you need to be saving and investing for retirement. But I just want to make one thing very, very clear from the off, and that is, that doesn't mean that you should not save. I think it's perfectly reasonable to have a savings account to cover various things. Maybe you've got a savings account to cover your emergency fund, maybe you've got a separate savings account and that's how you budget for your holidays. This is not the death knell of the savings account. All I'm saying is that saving has its place in building your financial future, but so does investing. But the other key thing, the diamond in the rough when it comes to investing, is compound interest. So very, very quickly, compound interest is, let's just say you take your £10,000 that you had in your savings account and you decide to invest it. And the market on average will return between, it varies, but between 7 and 9% every year. And so what that means is that your money will grow, and then the next year your money will grow, but by your principal amount plus your previous interest. And so what you get is this exponential curve upwards. And that is really the power of compound interest. Now, you might be thinking, well, where the hell have you got this 7, 9, 8, 12, 14% average returns from? And the short answer is, historically, on average, the S&P 500, which is the top 500 companies in America, have typically earned between 7 and 9% every year. Now, some years it's down, some years it's up, so that is the average rate of return. We should be very, very clear about this. And when you look at the comparison for the FTSE, it's between 5, 6, sometimes 7%, depending on the time frame. And so that's what really the key thing is. Investing is not for your day-to-day transactions. Investing is there to cover your longer-term financial goals. And that's for two main reasons. The first is it's a greater time horizon for you to be able to make contributions to your investment account, but also it gives that compound interest just more time to work. And so let's just look at an example. If you put £150 a month into, let's just say, an investment account of some kind, we take our average growth rate of say 8%, and over a time period of 30 years you'll have £225,000 in that account. Pretty great, right? But you will have only made about £54,000 in contributions. The remaining £170,000 will have been the growth in the overall value of investments. And hopefully this diagram will really help to illustrate the importance of the compound interest and the interest that you earn over time, and therefore why investing is better than just saving for retirement. So I think one of the key things that you also need to be thinking about is there is what's kind of reasonably well documented is the risk return profile. So lower risk investments will basically yield a lower rate of return, and the same is true when you're looking at ISAs, but then higher risk investment decisions will lead to higher returns. Now, I think it's also worth mentioning that because we're talking about longer term financial investments, that it's very easy to get caught up in the ebbs and the flows and the ups and the downs, but that's not really what we're looking at. What we're looking at is the average return over a long time horizon. So just bear that in mind. So now we've talked about why investing is so important to building your longer term financial wealth. Now we come on to the second part of the video. What is the ISA and how can it help facilitate your journey? And is it effectively a tax-free wrapper which you can start to put all your various investments accounts in, but, and this is the key, this is the thing that gives it the god tier status when it comes to its importance when it comes to building longer term wealth. Any investments that you have that sit within an ISA will be exempt from tax. That's capital gains tax, that's income tax, that's dividend tax. And so it just means that if you think about how much of your money you give away every month in tax to not have to pay that on income which is only going to grow over the longer term. Key goods, absolutely key goods, like chaos will ensue. But there are a couple of caveats, as always, with such things. So the first thing is you can contribute up to £20,000 in your allowance every single year. This comes with two important caveats. The first is that your allowance doesn't roll over from prior years, so any unused balances, if you don't use it, you lose it. Cash ISAs. So the cash ISA is, like, let's just be real, it's basically a savings account, but it has also simultaneously made the savings account kind of redundant. So one of the things we talked about in our previous video is that now, depending on which income tax bracket you fall into, you get a personal savings allowance. So that's money you can earn from a savings account which won't be taxed. Now, one of the criticisms from the previous video is you still need to have, even though interest rates have gone up, you still need to have a lot of money sitting in a savings account in order to breach those thresholds. So that's the first thing. But what the cash ISA does is it means that any interest that you earn from your cash ISA is exempt from tax right off the bat. And so really it does kind of beg the question what a savings account ultimately will do, but no, never mind. That's another topic for another video. But at the same time, with interest rates having gone up, people are potentially breaching those thresholds, and so by putting your money into a cash ISA rather than having sitting it in a savings account, you can potentially save money on your taxes. Now, I think it's worth bearing a couple of things in mind. There are a few different types of cash ISA, so there's like the ISA, and then the cash ISA is a kind of ISA, and then you've got different kinds of cash ISA. See what I mean about like unnecessary complexity? But there are a few different kinds of cash ISA. As we kind of talked about the risk-reward ratio, one of the things that you'll also find when it comes to cash ISAs is you have this kind of sliding scale. If you want quick access to your money every time, then that will basically give you the lowest possible rate of return or the lowest interest on your account. And if you're able to lock your money away for a longer time period, then that's going to guarantee you basically a higher rate of interest. Now, I think we should also probably worth mentioning things like car insurance, home insurance. When it comes to cash ISAs, I think there is a lot of value in shopping around and just keeping an eye on making sure that you are still meeting all the necessary criteria. There are all sorts of criteria about things like the amount of money you have in the ISA, how much you contribute every single month in order to qualify for different rates of interest. It can be very complicated, but just keep an eye on it every so often to make sure that you are maximising the value that you're getting from your particular cash ISA. And don't forget, you can just transfer it across if you find a better rate. Now we get to like the pinnacle, the peak, the one, the only, the stocks and shares ISA. In my view, one of the most important tools when it comes to building longer term financial freedom. And that is, again, for two main reasons. The first is it allows you to invest, and as we talked about earlier, the importance of investing in order to secure your financial future really cannot be overstated. And all the gains and all the income and all the dividends that you get from investing, tax free. Boom. Like, just end of the line. Cut, everything you need right there. And so what does the stocks and shares ISA do? Well, basically, it gives you the opportunity to invest in stocks and shares of individual companies. You can also invest in index funds or ETFs, which are a collection of stocks and shares of companies that sit within a single tradable security. Or you can trade in bonds, which are basically loans that have been made to governments around the world. Now, all of this is very complicated. This, I think, warrants its own separate video, which I will probably make. Subscribe so you don't miss it. Which, you know, let's save that for another time. But basically, it gives you the opportunity to participate and invest in all of these different mechanisms. They don't have to be very complicated. You can just buy a single individual global index fund, which will charge you very low fees. But the critical thing is that as you invest and as you build your portfolio over time, all the gains and all the income will be exempt from tax. Like, boom. Done deal. A great deal, if ever there was one. Now, when it comes to these discussions, there's often this ISA versus pension thing, blah, blah. Now, in my view, they are one of the things we talk about a lot on this channel is making sure you're using the right tool or the right financial instrument or the right budgeting method for your particular circumstances. And I think that's included when it comes to this debate between pensions and ISAs. In my view, your pension and ISA should be doing different things. But one of the big benefits that the ISA has over the pension is that there's no upper threshold. If you are someone who is contributing, if you're fortunate enough to be able to contribute the maximum £20,000 a year and you're investing over a 30-40 year time period, you know, the £1 million cap that you'll hit with pensions doesn't exist when it comes to ISAs. Now, one critical difference that we should probably highlight at this stage is you will earn a salary, you'll make pension contributions, which, as we know from previous videos like this one, are exempt from tax, but you'll get taxed on the other end, basically. So when you start to draw money out of your pension, that's when you start to pay income tax. Lots of people say, oh, pensions are a scam because you're taxed twice. It's not true. But then when it comes to the ISA, you earn a salary, you pay tax on that salary, and then you make contributions. But once you pull money down from your ISA, unlike with a pension, that money isn't taxed. So it's a critical difference which I think we really should illustrate. Both, in my view, both are long-term financial investment vehicles, but should be used differently. So use them differently and use them accordingly. Next is going to be the Lifetime ISA. So the Lifetime ISA was launched in 2017 to help younger people basically save for their first home or save for retirement, and basically the government will guarantee a 25% top up of all the money that you invest. Now this has a £4,000 per year contribution limit or allowance, so unlike all the other ISAs which have a £20,000 limit. We'll come onto allowances and limits later on in the video, but it can be a really kind of nice balance between the two. And the Lifetime ISA is a weird kind of halfway house. You have the cash Lifetime ISA, which works just like a cash ISA, including the government top up, and then you have a stocks and shares Lifetime ISA, again kind of combining the two, but it ends up, in my view, being kind of not very useful. There are also some criteria, so you can open it from the ages of 18 to 39 and you can pay into it until you're 50, so there's just those caveats to look out for. But you think there's caveats on the way in, there's also caveats on the way out when you want to try and pull your money out to use it. So when you're trying to pull your money out, there's even more caveats. So the first thing is it has to be going towards your first home, or you have to be over 60. So it goes back to this point of funding retirement or funding a first home. And if you want to, you can pull that money out, but you'll face a 25% penalty. Now there's all kinds of various campaigns. Martin Lewis has launched a campaign. It's a weird one. Personally, I don't have a Lifetime ISA. I don't necessarily view it as being overly useful. That's just my view. Next, I don't want to spend too long on this, but you have your Innovative Finance ISA. So this is basically like P2P funding. It's a bit weird. So you can, through an intermediary, you lend your money out to people, and any interest that you make as your return is tax-free. But from my perspective, you know, if the person obviously, or if you don't get that money back, then you'll just lose all of that money. So it is kind of higher risk than a lot of people make out that it is, which has always been a bit weird to me. So it's just another thing to bear in mind. Now, basically, the intermediary that you're lending in is called an IFISA. Okay, another acronym for us to decipher. And then we have the Junior ISA. Now, I think the Junior ISA gets a bad rep for a few reasons. So a Junior ISA is basically an account you can open for a child or a dependent if you're a parent or legal guardian. Now, you can open it for your children from as soon as they're born, and you can make contributions at up to £9,000 a year. These contributions fall outside of your £20,000 a year ISA limit that applies to pretty much all the other ISAs except for one. And what this basically just means is you can invest on behalf of your kids, and you know, it just basically means, as with the stocks and shares ISA, you can invest in stocks and shares, and as the value of that pot grows, they won't pay any income or any capital gains tax on that money. Now, they can take control of their Junior ISA from the age of 16, and from the age of 18, it will completely transfer over to them. So let's just say you've put lots of money away for your kids to enjoy, to help them do responsible things with it. Yeah, I mean, I've got 2 boys, so responsible things would probably not be at the top of their priority list, so it's just something to bear in mind. But what it will basically do is when they turn 18, it will just convert into a fully fledged stocks and shares ISA. Now, the reason why people give the Junior ISA a bad name is because they say, well, and it's a fair criticism, just to be clear, they say, well, so if you put money into a Junior ISA, then basically that money cannot be accessed by you or the child until they turn 18. So people, the criticism is generally, if you're not maxing out your own personal ISA limit, then it's not worth having a Junior ISA. And that is a fair criticism. That's not the bit which I would contest necessarily. I have Junior ISAs for both of my kids. We covered this in another video, how to make your kids millionaires. And I think the important thing to bear in mind for me is that I like to have money in different pots. So I can just go onto my, obviously Vanguard, I can just go onto my ISA homepage and I can see, right, my eldest boy has got this much in his ISA, my youngest boy's got this much in his ISA, I've got this in my own personal ISA, and so it just offers that kind of level of separation. And again, sorry to plug another video, but this is something we talked about in another video about how to automate your finances, and I just think having separate accounts makes a lot of sense. We make monthly contributions every single month, and then we also make contributions on their birthday every year, and we basically view that money as being to help them get onto the property ladder, and if they decide to go to university, to help them go to university completely free, because you know, the rates on student loans right now are absolutely fucking insane, like proper wingnut shit, so whatever. And finally we have the British ISA. Now, I have been very critical of the British ISA in my other videos. I have got a bit of grief for it in the comments, but you know, and basically the British ISA means that even if you top your £20,000 ISA allowance, you can invest an additional £5,000 into British companies. Now, it should be very clear at this stage that there is still consultation going on. So if a country is based outside of the UK but they do most of their business in the UK, does that qualify? If a British company is based in the UK but does most of its business outside of the UK, does that qualify? So there's kind of a lot we don't know with this one, to be totally honest. My main criticism of it is that so few people even have a stocks and shares ISA. I think it's 3% of UK adults have a stocks and shares ISA, and less than half of those people maximise their £20,000 limit. So the idea that people need another £5,000 is just kind of a bit silly. So that's my main criticism. So when all is said and done, and for you nosy parkers out there, what do I do with my money? Well, the short answer is I make sure that I am maximising my pension contributions that my employer will match into my pension. Then I have a stocks and shares ISA. I contribute monthly to this every single month, and just without fail, it's just, as in this video, it's another thing that's automated. And then I have 2 junior ISAs for both of my boys. As I said, money goes in there every month and every birthday. And the idea is that they're each doing a different thing. My pension is basically there to give that kind of more stable income for when I retire. The stocks and shares ISA I can afford to take a slightly higher risk on because I've got my pension. And then the junior ISA for the kids has a completely different purpose. And one of the things we talked about in the previous video, which I will always talk about, is making sure you're using the right account for the right financial objective. So hopefully we've covered absolutely everything you would ever need to know about why investing is a good idea, and therefore why the ISA can be such a powerful tool for you. We've covered all the ISAs, we've skipped over some of the details, but I think for the most part this is going to be really the introduction to help you decide which provider you're going to go with. But all of this can go completely awry if you end up using the wrong provider. We're going to be going through some of the best stocks and shares ISA providers in the UK, and then I'll be ranking these various ISAs on my proprietary ISA ranking scoreboard. At the end of the video we're going to be going through 2 things. The first is going to be, I'm a former investment analyst and these are the platforms that I use, and then the second thing is going to be a 4-step process to decipher which of these platforms is going to be best for you. But before we get into it, I should mention this is not necessarily financial advice, this is for information only. The value of your investments can go up and down, but all of the providers that we'll discuss in this video are FCA regulated and therefore covered by the Financial Services Compensation Scheme of up to £85,000 per individual per broker. So we're going to start off with a strong contender, which is Trading 212. Now Trading 212 has been around for a few years now, but I think it's really right up there with some of the absolute champions, some of the heavyweights in this industry, and that's for a few main reasons. The first is that they have over 13,000 potential investable funds and securities which you can invest in. That covers ETFs, that covers index funds, that covers, and importantly, individual shares of companies. So it's off to a really good start. But the key thing, and as I mentioned, fees are the enemy. The key thing which I think Trading 212 really gets right is their fees. Now, if you look here, they basically have an FX fee of 0.15%, but you can, for the most part, trade pretty freely and not incur any fees. But even their FX fee, when you compare to other providers in the UK, is kind of really competitive, truth be told. But if you want to buy shares denominated in a currency other than in pounds, you will have to pay this 0.15% fee. So if you want to buy shares in Apple, Microsoft, Tesla, whatever, they're all denominated in dollars, so you will have to pay the exchange fee. Now, one of the things that I do like about this is every time you go in to place an order, it does actually show you the amount of fee that you're going to get charged. It's not just some thing that gets deducted at the end of the month. So I think whilst there are fees there, they are transparent about them, or what few fees that they have, they are actually transparent about them. But when you start to look at the overall reviews, you really start to kind of really identify why this is such a strong contender in this area. So when it comes to variety of funds for Trading 212, I think it's right up there. Not only have you got individual shares, ETFs, index funds, you've just got a plethora of managed funds as well. So it's a green for this one. Next is fees. As we've said, they have really competitive fees. You only really pay the FX fee, you pay a deposit fee, but there are ways around this. So again, another good one. The app, I think the app is up there. Best in class app as far as I'm concerned. Very intuitive, very easy to use, very easy to navigate, and as I mentioned, transparency when it comes to the fees, so it's a real green one there. And finally, the option for other accounts. This is probably one of the drawbacks. A lot of the other providers that we're going to be talking about in future have SIPs, they have general accounts, they have other accounts which are available, and Trading 212 doesn't really have them, so it's probably really the only area where I would mark Trading 212 down. Next is Vanguard. Now, I must say, Vanguard, as I've mentioned in other videos, is one of the providers that I use. I've got junior ISAs for my kids, I've got SIPs, I've got an ISA there for me, an ISA there and a SIP there for my wife. So it's a platform that we use really quite a lot. And the founding principle of John Bogle, who founded Vanguard, was that fees were the devil. Kudos to him. Fees were the devil and they should be reduced at every conceivable opportunity. And the truth of the matter is, when you start to look into an awful lot of these high-flying hedge funds that offer these absolutely stellar returns, I think it's also worth noting that they tend to do well in up markets when everyone's doing well. The kind of rising tide lifts all boats. And I think for the most part, it's been reasonably well proven that actually a lot of these actively managed funds, after you take into account fees, just can't even catch up with an index fund. So this is something that Vanguard really focuses on. Something like their S&P 500 fund, which I personally invest quite heavily in, has got a OCF, an ongoing charge fee of 0.07%. So their focus on fees is really encouraging. But all of this comes at a cost, unfortunately, for Vanguard, which is if you sign up to Vanguard, if you're in the US, they have a plethora of potential investing options. But in the UK, they only really have a few options, which are going to be funds which they actively manage. So now, I should just mention at this stage that it's a pretty reasonable statement to say that the only thing you really need to invest in is a global low-cost index fund. So do you really need anything over and above that? Conceivably not, but we're going to go into more detail about this at the end. But you only have Vanguard funds. Now, these include their life strategy funds, they include their target retirement account funds, which are more actively managed and have slightly higher fees. But you know what? In terms of fund choices, it doesn't rate too highly. Is it all you need? Up to you. But I think the key thing with Vanguard is they have actively tried to expand the overall fund offering that we have in the UK. So whilst the selection may not be that great at the moment, I think it is something that will get better in future. But there is one thing which I think we probably should mention, and that is Vanguard is one of the largest funds in the world, managing trillions of dollars. So you could make a pretty reasonable case that actually the fees are pretty competitive. They're not the absolute best, but they're reasonably competitive. But you are backed by a behemoth, an absolute Goliath in the investing world. So are the fees that you get potentially, is it worth it for that extra security? Conceivably, I think you can make a pretty reasonable case there. So let's go through our list. In terms of variety of funds, it's got to be a red on this one. I just don't think they're up there. And when you look at some of the other platforms we're going to look at later on in the video, I think you're going to struggle to make a case there. Fees, I think the fees are still very competitive. They do have some bits and bobs in there which are a bit more expensive. For the most part, I don't think they're worth it, and it's not something that I invest my money in. They are online only. Now, just a quick one on this. Whilst I would generally say this is a bad thing, it depends on your overall personality and your overall investing strategy. If you are naturally a worrier, then having something on your phone where you can check the value of your ISA 82,000 times a day, probably not worth it, but it's going to be a red nonetheless. And finally, other account options. You know what? As I mentioned before, I have basically everything with Vanguard. Junior ISAs, SIP, blah, 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 pensions, blah, blah, blah. Absolutely everything. So it is helpful from that perspective. So Vanguard, I'd keep a lookout. Next is Invest Engine. So Invest Engine's a bit of a funny one. Whilst I think, for the most part, I rate Invest Engine. I think they offer a really good service. The fees are very competitive. We'll go into a bit more detail. But you can only really invest in funds. You have about 600 that you can invest in, so the choice is slightly higher than Vanguard. But I would view their competition really as being Trading 212, and Trading 212 have got like 13,000. So for the most part, I don't know. I just don't think, it feels like they're somewhere in the middle. They have more than Vanguard, but that's not really their competition, but they've got way less than Trading 212. But you start to look at the fees, and this is where it kind of starts to make a lot more sense. They charge particularly low fees, but one thing you will notice is that in their comparison tables, they tend to not compare themselves to Trading 212. So an interesting omission there. So whilst the fees are low, great, have at it. I think it makes a lot of sense. But gradually, I think those fees are going to start to tick up. Now, having said that, there are some fantastic introductory offers, which if you start to really take advantage of, they can start to make a pretty big difference. You can get, and just on that, if you're transferring over an ISA, you have this sliding scale, so you can gradually increase the amount of effectively cashback you'll get depending on the size of the portfolio that you're transferring over, and it can get up into like thousands of pounds. So not a bad sign-up bonus. But it does sort of remind me of like when Spotify used to be free. It's kind of, it was for a bit, and now it's not, and now it's only getting more expensive. See what I mean? So where do I rate this one? On variety of funds, I don't know. So on variety of funds, I'm gonna have to give it a red. I just don't feel like it's really up there with where it should be. In terms of fees, it's a green. They are really good on fees. I think it's one of the most important areas. The app, again, not quite as good as Trading 212. I think it is reasonably easy to use. I like the functionality where you can create effectively a fund of funds. So I think that's worth having. But in terms of other options to invest in, it is kind of limited, and so I think this will be something that they'll hold it back. Hopefully with all this additional money that they're raising, these additional funding rounds will lead to this extra functionality. So SIPs, junior ISAs, junior SIPs, all that sort of thing. Next is free trade. So free trade I find to be a bit frustrating. Again, app is pretty good. It's not the best, but it's reasonably intuitive to use. But I think one of the problems that free trade has is they end up in this kind of weird middle ground where they're not quite competing with Trading 212, but you still have to pay monthly. So let's just work on this for a sec. If you look at what the fees are monthly, if you're investing, say, hundreds or a couple of £1,000 a month into your ISA, then these fees might seem kind of small. But if you are someone who's investing like 50 quid a month, which is still worth doing, or 100 quid a month, then actually paying this sort of money in fees can start to feel, it feels like it's a bit much. And one thing that I find to be really annoying, and I know why companies do this, is to sort of dangle, oh, but if you paid a bit more money every month, and they dangle these potential options in front of you. And I think doing things like paywalling certain companies, so not being able to invest in certain big tech American companies, is really annoying. Really, really annoying. Gold stars, A+ is all round. I think it does a really good job actually of easily showing all the possible options. The fees are still quite low, but as I say, it may be the case that they do increase over time. And there is kind of a lack of other products that are available, so we'll give this one a red. Hargreave Lansdown. Now, Hargreave Lansdown is like living in a Tesco Express and then having your eyes open to the world of Costco. If you know, you know. The number of potential things that you can invest in with Hargreave Lansdown is absolutely bewildering. There is stuff all over the place. But the downside of all that choice is fees. Fees abound absolutely everywhere. Now, when you start to look at some of the trading fees, you start to look at how some of the fees are structured based on the size of your portfolio. I think invariably what you come away with is if you have a lot of money invested, if you're a very sophisticated investor, then I think Hargreave Lansdown to some degree does make sense. But for a kind of middle of the road or beginner investor or just a casual investor, it's maybe not going to be the ideal platform for you to be looking at. And for the most part, I don't necessarily know that they market themselves as being a competitor to Trading 212. So it's kind of hard to assess on that basis. But you also pay every time you want to trade. So again, it feels as though they're addressing almost entirely different markets. The difference between a Trading 212 is for a new beginner, whereas a Hargreave Lansdown is for an absolutely professional investor, someone who has a lot of money to be investing and they have all of these potential things that they want to invest their money into. So whilst to some degree maybe the illustration there is to try and say, we are sophisticated investors and we know what we're doing, that's why it's maybe more expensive, but I don't know. One thing I would say, they do have lots of free resources that are available. They do have lots of news and information on their app. The app is not it's fine. It's not great. So, if we go through the list, app I would say is a red. Choice of things to invest in, absolutely vast. So it's a firm green. It's a red on the fees because it is expensive. But I think one of the things that really does claw it back for me is not only do they have lots of things you can invest in, but they also have lots of products available. So you can have your junior SIPs, your junior ISAs, your SIPs, your ISAs, general investment accounts. They do everything. So that for me is the thing which kind of claws it all back for Hargreave Lansdown. Interactive Investor. Now, they don't suffer from this problem. They are a UK-based company. They're based up in Manchester, I think. And so they don't suffer from being based in the US and trying to be made to fit or to service consumers in the UK. They are UK based from the off. And I think that means that they have way more customizable or way more tailored experiences to UK investors, which is great. But just immediately off the bat, look at the complexity of their fee structure. That's insane. You could descend into absolute madness trying to work out this fee structure. So it is just something to bear in mind that I think for the most part, it is complicated. Maybe if you're trading just on your ISA, then it's not too bad, but it feels like it's very, very complicated. In my view, the thing that really sets apart Interactive Investor is their SIP offerings. Their SIP fees are extremely competitive. They've got a good choice of funds. So it does feel like there is something there. Maybe you have your ISA someplace else, but you have your SIP with Interactive Investor. You know, I think there's potentially some value in it there. The app is also reasonably easy to use, not that intuitive, but it's got some pretty good features. So I think this is maybe the most important part of the video because it really distills everything that we've talked about so far. And that is how you're going to find a platform that works for you. So I think there's a few key questions that you really need to ask yourself and then pick your platform based on your responses to those questions. So the first is, how much money have you got to invest? Now, the reason why this is so important is that a lot of fees, like in the case of Vanguard, cap out at certain fund values. And so if you're over that value, then it can be a really, economical and competitive way to be able to invest your money. The next is your risk appetite. So it's very well documented that trading in individual shares of individual companies is more risky. Now, it can lead you to greater overall returns, but it is risky nonetheless. And so if you actually don't want to take that level of risk, you have no interest in trading for companies individually, you just want to buy index funds, you want to buy ETFs, then why do you need to have a provider that offers that functionality? So that is historically where Vanguard has had a very good reputation when it comes to very low cost index funds. So that's another thing to bear in mind. The third thing you need to think about is, how often are you going to trade? Are you going to deposit money? Do you get paid weekly and you want to do it that as part of your payday routine? Video on such a topic would be here. It's just another thing to bear in mind, and that's because some of these, like for example Hargreaves Lansdown, you have trading fees which you have to pay every time you want to trade. So if you're going to make like an annual, it gets to the new tax year and you're just like boom, drop all your money in one go, then that can make a bit more sense. If you get paid weekly and you're going to make contributions on that basis, then it's another thing to think about. So where would I rate each of these providers overall? This is based on my own personal feedback and my own personal opinion on it. Well, I think to the S tier, the godlike category has to go to Trading 212. They have very low fees, they have a really broad range of potential investment opportunities. Their app is very easy to use. You can trade in a general account, but you can also have an ISA. I think it's really, really great. This is like the god tier. Now, closely followed in second is, I would say, this is like maybe an S, maybe an A grade, is going to be Invest Engine. Invest Engine doesn't have quite as many potential opportunities for you to invest as Free Trade, and I think that's really where it gets knocked down. But, my initial reservation is that fees are gradually going to increase. In the kind of A/B category is Vanguard. Now, whilst they have worked to increase their funds, I think historically one of the founding principles of John Bogle was that people should be charged very low fees. And so it is I can't explain how insane it is that to buy a Vanguard fund through a competitor is cheaper than to buy a Vanguard fund through Vanguard themselves. Like, that is insane. That really feels as though that's the sort of thing that they need to be on top of. So for that reason, that's the thing that makes me want to nudge it down a little bit to a B, but let's keep it A grade for now. I think A grade is perfectly fine. It is still an absolute stalwart for most people when it comes to investing, and I think it is a well-deserved reputation. Another B grade, Interactive Investor. I think the choice is pretty good. The app is reasonable. B grade seems reasonable. On the C grade, I would say we have Free Trade. They are catering to quite different audiences, so it's not really my bag. Maybe this is my selfishness shining through, but it's not really my sort of thing. And then on the D grade, I would say we have Hargreaves Lansdown. And that is mostly because the fees are very, very high, like very, very high. If you have a lot of money and you're a sophisticated investor, then I think fine, it makes some sense for you. If you're going to be trading in vast quantities of money, then a $5.99 trading fee is probably, if your trade is like 100 grand, then like, who cares? But I think just quickly on this, and that is one thing, all of this doesn't matter. Which platform, which this, which that, which funds or blah, blah, blah. The main thing is finding a trading platform that works for you, finding a trading platform which suits your individual needs, which makes economic sense, which does everything that you want it to do. Because at the end of the day, you're here, you're watching this video, and you've decided to start investing. You've started to take one of the most important steps, one of the steps which most people will not take when it comes to pursuing longer term wealth and financial freedom. So maybe you think I'm talking absolute bobbins. Entirely conceivable. I have the IQ of, a cartoon villain, for example. if you cracked my head open, there wouldn't be enough brain inside to cover a small water biscuit. So find one that works for you, invest accordingly, invest consistently, and as long as you are investing, that's the main thing. And so for those that want to know what I do as a former investment analyst, well, the short answer is the majority of my portfolio sits within my Vanguard account. It's basically it's where I've got everything. So it's, to some degree, it's convenience, but also I tend to buy very low cost country specific or region specific index funds, so S&P 500 or low cost global index fund. And so I think for the most part, for most people, I still think Vanguard is a really, really good option to go for. And that's because whilst I have I appreciate that this feels a bit contradictory. Whilst I think Trading 212 is better as a platform, I think that for most people, Vanguard is a better platform overall. And that's because, as I mentioned, most people don't really need to trade individual companies. Most people don't need a really good app. Most people, for 99% of people, just being able to go onto the website, set up a monthly deposit of a fixed amount that they just know will go into that every single month, and they can check in on the value of it occasionally. It's all you need. It's all you need, really. So I use Vanguard for that, and then for being able to trade in individual stocks, it is my preference to use Trading 212, as for all the reasons that I've mentioned. Obviously, this is the first tax year when you can put money into multiple ISA accounts, so take advantage of it. I think that's really going to be the way to go this year. So in this video, we've talked about some of the most prominent trading platforms for stocks and shares ISA based here in the UK. I've given an overall ranking to them, and I've dived into some detail about fees and apps. And we have this. This is the sum of the whole video. We're going to be going through the mistakes I see people make with their ISAs time and time again. Now, in historically not awesome fashion, I came across this statistic that only 3% of UK adults have a stocks and shares ISA, and less than half of those 3% actually maximise their ISA allowance every year. As always, this is not necessarily financial advice, so make sure you're seeking the help of a qualified professional. First is making lump sum contributions. Now, this is an important one right off the bat. The new tax year comes around, they're very pleased with themselves that they drop whatever the amount is into their ISA. But this is problematic for a couple of reasons. The first is that if you contribute on a consistent basis every single month, it keeps you more accountable, you can incorporate it into your budget, and you end up not using your ISA as an emergency fund. You've got all of these things included in your budget, and so means that you're able to hold yourself way more accountable when it comes to making sure you're actually making those consistent contributions to your ISA. This is something we covered in another video about how to automate your finances. Link is just here, and it's really such an important video which I really encourage you to watch. And the other thing is, by including it in your budget, it means that you're not having to constantly fumble around to make sure, did I make the payment, how much, blah blah. It's in your budget and it's automated every month, and it's not as complicated as keeping up with the car crashing and timing the market. Again, this is another super dumb one, but okay. So there was this CNBC article that came out in November 2023. The majority of those gains came in a 10-day period. Not all at once, not all clumped together necessarily, spread over the whole year so far. And so what this really highlights is the importance of time in the market rather than timing the market. And so, linked to the previous point, by making sure you're making these consistent contributions, you're going to be in a position where you're going to be able to capture the majority of those benefits. So don't try and be a trader. You're not a trader. There is plenty of people who are very well paid, very smart, went to the best universities and study this shit all day long, and they can't beat the market. So just be real. I don't do it, I just buy index funds. Time in the market will always beat timing the market, ignoring fees. Now, you can really drop your conker when it comes to fees, so let's just go through a little example here. The truth of the matter is that fees can be a stealth tax like no other. A very small percentage change in fees can make a vast difference, and that's for two main reasons. The first is that because you're investing over a long time period, compounding is working in your favour when it comes to building the overall value of your portfolio, but at the same time it is also giving the fees an opportunity to grow as well. So this small change in fees can make a great big difference to the size of your overall pot. Here's just a very quick example. You'll see if you're making the same monthly contributions, you compare the fees of 1.5% to 2%, so half a percentage point difference. Not that great, it doesn't seem, but the value of the overall pot after 40 years is about £66,000. So that's a lot. That's really a lot. And so just making sure that you're paying attention to the fees that you're charging. Now, we're going to have another point that we're going to come on to when we talk about making sure you're selecting the right platforms. The wrong type of ISA. Now, in the next video in this series, sub so you don't miss, we're going to be going through the different types of ISA, and we're going to be doing this kind of really comprehensive view about what all the ISAs look like. But for the most part, there are a few different types of ISA. We're not going to go through all of them. What I find invariably is that lots of people use the wrong sort of ISA for their overall objective. If you're saving for a house, then a lifetime ISA makes absolute sense. You get a guaranteed 25% top up from the government. Sound. But it's not necessarily the tool that I would want to use for building longer term wealth and securing my retirement. That's more of a stocks and shares ISA. And so really making sure that you're using the right ISA for the overall financial objective. Now, that's not to say that you can't have a lifetime ISA for saving for your first home and a stocks and shares ISA for building your financial future. Just make sure you're using the right account. This is something we talked about in another one of our videos. Thinking the British ISA is a good idea. Now, I've been giving the British ISA a lot of, shit, because it's a shit ISA as far as I'm concerned. So in my view, the British ISA is not a very good idea. It's frankly like investing in the Majesty herself, picking the wrong provider. So we mentioned this sort of when we were talking about fees. Make sure you're picking the provider that does what you need it to do. Me personally, by individual preference, and because, as I say, I have a very small brain, I'm an index fund guy. It's nice and easy, it's diversified risk, and as we talked about critically, the fees are very, very low. Because I'm an unimaginative soul, I am with Vanguard, obviously. My S&P 500, the fees are 0.07%. Very, very low fees. But if you're someone and you want to maybe play around with buying individual shares or stocks, you want to do blah, blah, whatever, you want access to a whole plethora of additional options, just make sure you're really selecting an ISA provider that works for you. Make sure you're doing the right account for the right financial objective, but at the same time making sure you're choosing the right provider for that ISA. Saving instead. In this high inflation environment that we've found ourselves in for the last few years, one of the things to come out of it is higher interest rates, much higher interest rates when you compare to the historical averages of recent years. But at the same time, as is with all things in economics, there's two sides to this coin. People's mortgage costs have gone up, people's credit cards have gone up, but savers get more from their money. But you still have to have vast sums of money in a savings account in order to breach the savings allowance, which is dependent on what income tax bracket you find yourself in. It's on the screen now. I think it's £1,000, it's £500, and then it's nothing. But even if you manage to get a reasonably good rate on some of these ISAs, invariably you need 25 plus grand easily in order to breach that limit. And so people tend to think, well, I've got this cash ISA, so whatever, why do I need a stocks and shares ISA? So don't necessarily fall into that trap. Forgetting about your family. Now, I'm not talking in a David Cameron type situation where he left his kid at a pub or something, but this is something that we talked about in our most recent video. But the truth of the matter is that if, for example, it's you, your partner and 2 kids, you have about 58 grand of ISA allowances between the 4 of you. And so that's a lot. That's really, really a lot. If you are maximising all of those allowances every year, then, amazing work. Well done. You have won at life. As always, this channel is not giving out relationship advice. The relationship advice is far beyond the remit of this channel. We are providing information and hopefully helping you make informed financial decisions as much as we reasonably can. Now, this is something we discussed in another video, again, how to make your kids millionaires. And one of the conclusions, and one of the inescapable conclusions, is that for the most part, a junior ISA is not really worth it unless you're maximising your own contributions. But, and this is an important caveat that I would include in this, the reason why people say that is because one of the drawbacks of a junior ISA is that if you put money into it, then you can't access that money. And then when your kid turns 18, it goes from being in your name to being in their name, and it converts to a stocks and shares ISA. Not taking the plunge. Now, this is absolute fly paper for knobheads, but some people just say, well, the ISA allowances might change, they might tax them, they might do this, they might do that. And all of that is true to some degree. But the truth of the matter is you can't make investment decisions based on a whole series of possibilities. You have to make the best decisions you can with the information you have at the time. There was lots of talk that Jeremy Hunt in the last budget was going to change the ISA thresholds, or he was going to change the limits or the allowances, and he didn't. And so if you were someone who held off putting money into an ISA, then the S&P has been on a pretty good tear since then, so you would have missed out on all of those gains. Now, if and when the legislation does change, or if it does at all, work with the information that you have at the time, and don't be an armchair quarterbacker, whatever a quarterbacker, not appropriately managing your risk. Now, this is kind of split into two. It is a not personal financial advice, but it is a generally accepted personal finance principle that when you're young, you want to generally have a portfolio that is more heavily weighted to stocks, and that is basically because although stocks are more high risk, they are therefore more likely to yield a higher reward. So they talk about the sort of balance between stocks and bonds, and so just making sure that if you want to follow this principle, that you are more heavily invested in stocks rather than bonds, and then the closer you get to retirement, maybe you want to balance it out so you reduce your share in stocks but you increase it in bonds for that lower risk but lower return. And so just making sure that you're managing that actively. But, and this is why you would consult a financial advisor, it's also worth mentioning that everyone's personal finance advice is circumstantial. So if you've got a really good pension pot and that is mostly invested in bonds because you've hit your retirement age and that is generating your steady income, then maybe you decide, well, I don't really need the ISA, I can afford to take a bigger risk. Not using your full allowance, this one's pretty short and pretty obvious. The ISA allowance doesn't roll forward if you have unused balances, unlike with pension allowances, so if you don't use it, you lose it. Easy. Withdrawing cash. So it can be very tempting to, see a shiny thing that you like and just think, wow, it's a few thousand quid, maybe I'll dip into my ISA and then I'll just put the money back in. And this is flawed thinking for two main reasons. The first is that, let's just say for argument's sake, you take 10 grand out and you buy a car, nice convertible or something, and then it takes you say 6 months to build it up again. You think, right, I'm really going to focus on it, but in that 6-month period you have lost out on those potential gains, just like the article we talked about earlier, and the majority of those gains came on 10 days. So you have potentially missed out on some of those days where your portfolio is going to have the greatest gain. So now, obviously, if you're going to lose your house, you've lost an income, then don't be sitting there going, oh, well, I'm not going to, the dragon sitting on a pile of gold going, well, I'm not going to touch my ISA. Obviously, if you have a big financial emergency that is going to have repercussions for you and your family, obviously it seems sensible to dip into your ISA. But for those things where just save up for them, and ultimately this is an ISA, this is an investment account, not a savings account, so treat it accordingly. Cashing over transferring. Now, you might be sitting there thinking, having just watched this video and thought, right, fees, I'm going to take a look at your fees, and you're horrified at the fees that your current ISA provider is charging. And so you go, right, well, I'm going to move over to this platform. I don't want to trade individual stocks. I just want low-cost index funds, so I'm going to move over to Vanguard. Surprise, surprise. You just think, right, I'll cash out my ISA, I'll take the money out, and I'll put it in my new one. Job done, right? Wrong. Very wrong. And that's for a few key reasons. So don't cash out an ISA, fill in an ISA transfer form. Now, again, it is different with every single provider, but actually for Vanguard, it's pretty easy to do. You fill in some like pedigree information, the account number, the approximate fund value, and they will basically just do most of the work for you. So if you want to move from one provider to another, make sure you're going through the correct process. You are not cashing out and then putting it in, and making sure you're going through the transfer process so that you don't eat into your annual allowance. Not reinvesting dividends. Now, your veins would have to be filled with the same gruel as Piers Morgan not to be taking a heed of this one. One of the key benefits of having something like a stocks and shares ISA is that the income and the gains and the dividends don't actually count towards your annual allowance, which is absolutely great. So when you're actually selecting your funds, generally I think it's really a good idea, and it's certainly what I do, to make sure that you're picking an accumulative fund. And this basically just means that if you get dividends every quarter from some of your holdings or whatever, that they get automatically reinvested, because as we've talked about, that will be one of the really key things when it comes to building wealth. And again, it's just another way that you can automate your finances to make sure that you're getting the maximum investment value possible. And conceivably, it will also save you a ton on fees. Fees bad. Fees bad. So as I mentioned at the start of the video, I think that some of this stuff is really important, and there's a lot of bad information out there. People are making lots of mistakes when it comes to their ISA, and I would absolutely applaud people for taking all these steps in the right direction to secure their longer term financial future. But just avoiding these mistakes is going to be really important. Thanks very much for watching. Peace.